A major shift is quietly unfolding across the world's oceans, and while it may not dominate headlines in the same way as wars or elections, its consequences could be just as far-reaching. Global trade is entering a new phase, one where the movement of ships, access to ports, and control over maritime infrastructure are no longer treated as neutral or purely commercial matters. Instead, they are increasingly being used as strategic tools in a broader struggle for economic influence and national advantage. At the heart of this transformation is a growing realization among governments that shipping is not just a background service supporting the global economy, but a powerful lever capable of shaping trade flows, raising costs for rivals, and sending clear political signals to markets and industries worldwide. For decades, international shipping operated largely behind the scenes, connecting manufacturers, suppliers, and consumers through predictable routes and standardized rules. Ports competed on efficiency, shipping lines focused on scale and reliability, and governments generally stayed at arm's length, intervening only when safety or security demanded it. That era is now fading. What has replaced it is a far more politicized environment, where maritime policy is increasingly intertwined with national strategy, industrial protection, and geopolitical rivalry. This shift did not emerge overnight. It has been building gradually, fueled by long-standing tensions over trade imbalances, industrial subsidies, and the concentration of shipbuilding capacity in a handful of countries. Over time, these issues have combined with broader concerns about supply chain resilience, economic security, and strategic dependence, especially after global disruptions exposed how vulnerable international trade can be when shipping routes are interrupted or ports become choke points. As a result, policymakers have begun to look at the maritime sector not just as infrastructure, but as a domain where influence can be asserted and leverage applied. Shipping lanes, port access, vessel ownership, and even flag registration are now being scrutinized in ways that would have seemed extreme just a decade ago. This new mindset has profound implications. When governments start linking port access to national affiliation or ownership structures, the rules of global trade change. Ships are no longer judged solely on compliance with safety standards or environmental regulations, but also on who owns them, who operates them, where they were built, and which flag they fly. These factors, once largely administrative, now carry economic and political weight. For shipping companies, this creates a far more complex operating environment. Decisions about fleet composition, corporate structure, and routing are no longer driven purely by efficiency or cost optimization. They must now account for political risk, regulatory retaliation, and the possibility that access to key ports could suddenly become more expensive or restricted altogether. Even long-established trade routes can no longer be taken for granted when diplomatic relations sour. For manufacturers and exporters, the consequences are equally serious. Shipping has always been a critical cost component, but it was relatively predictable. Today, that predictability is eroding. When maritime policies become tools of economic pressure, transportation costs can change rapidly and without warning. This forces businesses to rethink supply chains that were designed for stability and scale, pushing them toward diversification, redundancy, and contingency planning. These adjustments are not cheap, and they inevitably ripple outward, affecting pricing, delivery times, and competitiveness. Consumers, often far removed from the mechanics of global shipping, may not immediately connect higher prices or delayed products to port policies enacted thousands of miles away, yet the link is direct. Every additional fee imposed at a port, every rerouted vessel, and every delay introduced by regulatory uncertainty adds friction to the system that moves goods from factories to store shelves. As maritime trade becomes a battleground for influence, those costs accumulate and spread across the global economy. Investors and financial markets are also paying closer attention. Shipping and logistics, once considered relatively stable sectors, are increasingly viewed through the lens of geopolitical risk. Port operators, shipping companies, and even shipbuilders are now evaluated not just on performance and profitability, but on their exposure to political decisions and international disputes. This has implications for capital investment, infrastructure development, and long-term planning across the industry. What makes this shift especially significant is that it represents a departure from traditional trade conflicts. Tariffs, quotas, and sanctions target goods and companies, but maritime measures target the infrastructure itself, the physical systems that make trade possible. When ports and shipping access become instruments of policy, the entire architecture of global commerce is affected. This raises critical questions about the future of international trade. If access to maritime infrastructure can be adjusted for political reasons, how will companies ensure continuity? How will smaller economies navigate a world where major powers can influence shipping costs and routes through policy rather than market forces? And how will global institutions respond to disputes that play out not at negotiating tables but at docks and harbors? These questions are no longer theoretical. They are shaping real decisions being made today by governments, corporations, and investors. The choices made now will influence how resilient, flexible, and fragmented the global trading system becomes in the years ahead. As shipping moves from the background into the spotlight, it is becoming clear that control over maritime logistics is not just about moving goods efficiently, but about shaping economic outcomes and projecting power. In the sections that follow, we will examine how this transformation took shape, the key decisions that accelerated it, and why maritime policy has become such a powerful and contested tool in modern global trade. Understanding this evolution is essential because the future of commerce will be written not only in trade agreements and economic data, but in the rules governing who can move goods, where they can move them, and at what cost. As this new reality takes shape, the most striking development is how quickly maritime policy has shifted from a technical issue into a direct instrument of economic confrontation, particularly between major powers whose trade relationships underpin much of the global economy. What was once handled quietly through port authorities, customs agencies, and regulatory bodies is now openly debated at the highest political levels, with decisions framed as matters of national interest and strategic defense. This evolution reflects a broader change in how governments perceive vulnerability and leverage in an interconnected world. Shipping is no longer viewed simply as a service that enables trade, but as a strategic artery that, if controlled or constrained, can influence entire industries and even national economic trajectories. The logic behind this approach is straightforward. Modern economies rely heavily on just-in-time delivery, tightly coordinated supply chains, and predictable shipping schedules. Disruptions, even small ones, can cascade through production networks, causing delays, shortages, and rising costs. By targeting maritime access through fees, restrictions, or regulatory pressure, governments can impose immediate and tangible costs without resorting to more extreme measures. This makes maritime tools particularly attractive in periods of heightened tension, as they offer a way to signal, resolve, apply pressure, and test an opponent's tolerance for economic pain. However, this strategy also carries significant risks. When shipping becomes politicized, the stability of global trade is undermined. Shipping companies are forced to operate in an environment where commercial logic competes with political calculation. Routes that once made sense based on distance, fuel efficiency, and port capacity may suddenly become less viable due to policy changes. Companies must then decide whether to absorb higher costs, pass them on to customers, or attempt to restructure operations to reduce exposure. Each option carries consequences, not just for individual firms, but for the broader supply chains they support. This uncertainty affects investment decisions as well. Port expansions, fleet upgrades, and infrastructure projects typically require long planning horizons and substantial capital commitments. When access rules and cost structures can change based on political decisions, investors become more cautious. Projects may be delayed, scaled back, or redirected to regions perceived as more stable, reshaping the geography of global trade over time. The effects extend beyond major shipping lines to a wide range of related industries, including shipbuilding, port services, logistics technology, and freight insurance. Each of these sectors must now account for a higher level of political risk, altering business models that were built on assumptions of openness and predictability. For governments, the use of maritime measures reflects a growing willingness to integrate economic policy with strategic objectives. This approach blurs the line between trade regulation and geopolitical maneuvering. Decisions about port fees or access restrictions are framed not only in terms of fairness or competition, but as responses to perceived threats to national industries or economic sovereignty. This framing resonates domestically, where protecting jobs and industries is a powerful political message, but it heightens international tensions by turning routine commercial activity into a contested arena. Other countries watching these developments are taking note. As major powers demonstrate that maritime infrastructure can be leveraged for strategic ends, smaller and mid-sized economies may feel pressure to reassess their own vulnerabilities. Nations that depend heavily on foreign ports or shipping services may seek to diversify routes, invest in domestic infrastructure, or form regional partnerships to reduce exposure. This could lead to a more fragmented global shipping system, with parallel networks emerging to serve different political blocs. While such diversification may enhance resilience for some, it also risks reducing efficiency and increasing costs across the board. The broader implications for global trade governance are equally significant. International frameworks that govern shipping and port operations were designed for a world where economic cooperation was the dominant assumption. As maritime policy becomes more confrontational, these frameworks are strained. Disputes that once might have been resolved through technical consultations or arbitration now carry political weight, making compromise more difficult. This raises questions about how future conflicts will be managed, and whether existing institutions are equipped to handle a landscape where infrastructure itself is a tool of competition. At the same time, businesses and consumers are caught in the middle. Companies must navigate a patchwork of rules and risks, while consumers ultimately bear the cost through higher prices and reduced choice. The connection between port policies and everyday life may not be immediately obvious, but it is real. When shipping costs rise or routes become less efficient, those costs travel through supply chains, influencing everything from the price of electronics to the availability of basic household goods. This reality underscores why maritime policy matters far beyond the docks and harbors where it is enacted. It shapes the rhythm of global commerce and the stability of economies large and small. As this trend continues, the challenge will be finding a balance between legitimate national interests and the need for a functioning global trade system. Using maritime tools as leverage may offer short-term advantages, but widespread adoption of this approach risks normalizing disruption as a policy instrument. Over time, that could erode trust, increase volatility, and make global trade more expensive and less reliable for everyone involved. The direction taken now will influence whether shipping remains a shared foundation of global prosperity or becomes a contested space where economic power is asserted at the expense of stability. In the next phase of this story, the focus shifts to how these dynamics play out in practice, how specific decisions trigger real-world consequences, and why moments of escalation and reversal reveal just how fragile the balance has become. As the consequences of these maritime tensions continue to unfold, what becomes increasingly clear is that the true impact extends far beyond the immediate exchange of port fees and countermeasures, revealing deeper structural vulnerabilities within the global trade system itself. Modern supply chains are built on assumptions of reliability, speed, and cost efficiency, with shipping acting as the invisible thread that holds together production networks spanning continents. When that thread is strained by political decisions, even temporarily, the effects are felt almost instantly across industries that rely on seamless coordination. Manufacturers dependent on components sourced from overseas must suddenly contend with uncertainty about delivery times and costs, forcing them to reassess production schedules that were optimized down to the hour. A delay at one port can ripple through factories thousands of miles away, idling workers, slowing output, and increasing overhead costs that were never anticipated in original business plans. This vulnerability is particularly acute in industries such as electronics, automotive manufacturing, and advanced machinery, where components often cross borders multiple times before a final product is assembled. In these sectors, even small disruptions can have outsized effects, magnifying the consequences of policy decisions made far from factory floors. Shipping companies caught between political pressure and commercial realities face their own set of challenges. Fleet deployment strategies that once focused on maximizing efficiency must now account for geopolitical risk, regulatory uncertainty, and the possibility of sudden cost increases tied to port access. Decisions about where to send ships, which ports to prioritize, and how to structure long-term contracts are no longer purely operational choices. They have become strategic calculations shaped by the evolving relationship between major trading nations. This shift complicates negotiations with clients, as carriers struggle to offer predictable pricing in an environment where fees can be imposed, suspended, or reinstated with little warning. Long-term contracts that once provided stability now carry clauses addressing political risk, reflecting a growing recognition that shipping is exposed to forces beyond market supply and demand. For exporters and importers, the challenge lies in managing exposure without sacrificing competitiveness. Companies that rely heavily on trade between major economies must decide whether to absorb higher shipping costs, pass them on to customers, or seek alternative sourcing and distribution strategies. Each option involves trade-offs. Absorbing costs can erode margins, particularly for businesses operating on thin profit lines. Passing costs on to customers risks reduced demand and competitive disadvantage. Diversifying supply chains may reduce exposure to specific disputes, but it often involves higher baseline costs, longer lead times, and significant upfront investment. These decisions are further complicated by the fact that trade tensions can shift rapidly, making it difficult to predict which routes or relationships will remain viable over the long term. The financial markets respond to this uncertainty with caution. Investors closely watch developments in shipping and trade policy, recognizing that disruptions in maritime logistics can signal broader economic instability. Volatility in shipping stocks, commodity prices, and trade-linked sectors reflects concerns about future earnings, cost structures, and growth prospects. When major economies signal a willingness to use infrastructure as leverage, markets reassess risk across a wide range of assets, from industrial companies to consumer brands dependent on global sourcing. This reassessment can influence capital flows, affecting investment decisions not only in shipping and logistics but across the broader economy. Ports and logistics hubs also find themselves under increased scrutiny. As gateways to global trade, their fortunes are closely tied to shipping volumes and route stability. When political decisions alter traffic patterns, some ports may see declines in activity while others experience sudden surges. This volatility complicates planning and investment, as port authorities must balance the need to expand capacity with the risk that trade flows could shift again due to policy changes. Infrastructure projects that take years to complete are now planned in an environment where long-term assumptions about trade relationships are less certain. This uncertainty can slow development, reduce efficiency gains, and ultimately limit the capacity of the global trade system to adapt smoothly to changing demand. Beyond the immediate economic effects, there is a psychological dimension to these developments that should not be overlooked. Trust is a critical component of global trade. Businesses invest, hire, and expand based on expectations of stable access to markets and infrastructure. When governments signal that access can be restricted or made more expensive as part of political strategy, that trust is weakened. Companies become more defensive, prioritizing resilience over efficiency and hedging against worst-case scenarios. While this may reduce vulnerability in the short term, it can also lead to duplication of resources, higher costs, and reduced overall productivity. The cumulative effect is a global trade environment that is less dynamic and more cautious, with slower growth and fewer opportunities for efficiency-driven gains. Smaller economies in developing nations are particularly exposed to these shifts. Many rely heavily on predictable shipping routes to access global markets and attract investment. When major powers engage in maritime disputes, the resulting disruptions can spill over into regions that have little influence over the policies driving them. Increased shipping costs or rerouted traffic can make exports less competitive, strain foreign exchange earnings, and complicate economic planning. This highlights the asymmetry of power in global trade, where decisions by a few large players can have disproportionate effects on others. As a result, there is growing concern about the long-term implications of normalizing infrastructure-based economic pressure. If port access and shipping fees become standard tools in trade disputes, the stability of the global system could be fundamentally altered. Cooperation may give way to fragmentation, with trade increasingly organized along political lines rather than economic efficiency. While such a shift may offer perceived security for some, it risks undermining the interconnectedness that has driven global growth for decades. Understanding this broader context is essential to grasping why the current situation matters so deeply. It is not just about a specific set of fees or a temporary pause in their enforcement. It is about how the rules of global trade are being tested and reshaped in real time, revealing the fragile balance between national interests and collective prosperity. In the next stage of this unfolding story, attention turns to how governments, companies, and markets adapt to this new environment, and whether lessons learned from recent tensions will lead to greater stability or set the stage for further confrontation. As attention shifts toward the longer-term implications of these developments, it becomes evident that governments around the world are quietly reassessing how they view shipping, ports, and maritime infrastructure within the broader framework of national strategy. For decades, global shipping was largely treated as a neutral facilitator of commerce, governed by international norms and commercial logic rather than overt political maneuvering. That assumption is now being challenged. The U.S.-China port fee dispute illustrates how access to maritime infrastructure can be weaponized in subtle but powerful ways, creating leverage without the immediate visibility or backlash associated with tariffs or sanctions. This realization is prompting policymakers to rethink how much control they exert over ports, shipping lanes, and logistics networks, and how these assets can be used to protect national interests in an increasingly competitive global environment. In the United States, the debate has expanded beyond the specific issue of port fees to encompass concerns about supply chain resilience, industrial capacity, and strategic dependence on foreign logistics networks. Lawmakers and trade officials are increasingly vocal about the need to secure critical supply routes and reduce vulnerabilities exposed by recent disruptions. This includes renewed focus on domestic shipbuilding, port modernization, and regulatory frameworks designed to strengthen oversight of maritime operations. While these initiatives are often framed as economic or security measures, they also reflect a growing awareness that control over logistics infrastructure can translate into geopolitical influence. China, for its part, has long recognized the strategic importance of maritime access and has invested heavily in ports, shipping companies, and logistics networks both domestically and abroad. Its response to U.S. port fees demonstrates not only its willingness to defend its interests, but also its confidence in using precise, targeted measures that align with its broader economic strategy. By structuring fees to apply based on ownership, operation, construction, and flag registration, Beijing sends a clear message that maritime leverage can be applied with surgical accuracy, affecting specific actors while maintaining a degree of deniability under existing regulatory frameworks. This approach allows China to signal resolve without resorting to blunt instruments that could provoke more severe retaliation. For other nations observing this exchange, the lesson is unmistakable. Maritime infrastructure is no longer just a backdrop for global trade. It is a potential bargaining chip in economic diplomacy. Countries with significant port capacity or strategic geographic positions may increasingly view these assets as tools to enhance negotiating power in trade disputes or geopolitical negotiations. This shift has implications for international cooperation, as it raises questions about the reliability of access to critical trade routes in times of tension. Smaller nations that depend on open and predictable shipping systems may find themselves caught between competing powers, pressured to align policies or risk disruptions that could harm their economies. At the corporate level, these dynamics are driving a fundamental reassessment of risk management practices. Companies engaged in global trade are beginning to treat geopolitical exposure as a core operational risk, rather than a distant concern handled by legal or compliance departments. This means integrating political analysis into decisions about sourcing, production, and distribution, and investing in flexibility even when it comes at the expense of short-term efficiency. Multinational firms are exploring diversified port access, alternative shipping routes, and regionalized supply chains as ways to hedge against future disruptions. While such strategies can reduce exposure to specific disputes, they also increase complexity and cost, forcing businesses to balance resilience against competitiveness. Shipping companies themselves are at the center of this transformation. As intermediaries between governments and global commerce, they must navigate an environment where regulatory decisions can reshape markets overnight. The traditional focus on optimizing fleet utilization and minimizing costs is giving way to a more cautious approach that accounts for political risk and regulatory uncertainty. Some carriers are investing heavily in data analytics and scenario planning to anticipate potential disruptions, while others are seeking closer partnerships with ports and governments to gain insight into policy developments. These efforts reflect an understanding that adaptability will be a key determinant of success in a more volatile trade environment. Financial institutions are also adjusting their outlook. Banks, insurers, and investors increasingly factor geopolitical risk into lending and investment decisions related to shipping and infrastructure. Projects that once appeared stable may now carry higher risk premiums, reflecting concerns about future policy changes or disruptions. This can affect the availability and cost of capital for port expansions, fleet upgrades, and logistics innovations, potentially slowing investment at a time when global trade systems need modernization to handle growing demand and complexity. The cumulative effect of these shifts is a global trade landscape that is more fragmented and cautious than in previous decades. While the one-year suspension of port fees provides temporary relief, it does little to resolve the underlying issues driving this transformation. Instead, it highlights the fragile equilibrium that currently exists, where economic interdependence discourages outright confrontation, but strategic competition encourages the use of pressure points short of open conflict. This tension creates an environment of persistent uncertainty, where businesses and governments alike must prepare for sudden changes while hoping for negotiated solutions. At a deeper level, the situation raises fundamental questions about the future of globalization itself. If shipping and port access become regular tools of economic leverage, the assumption of free and predictable movement of goods may no longer hold. Trade could increasingly be shaped by political alignment rather than comparative advantage, leading to the emergence of parallel systems organized around competing blocs. Such a development would mark a significant departure from the integrated global economy that has defined recent decades, with far-reaching implications for growth, innovation, and living standards worldwide. Understanding these broader trends is essential to appreciating why the current dispute matters far beyond the immediate headlines. It is not simply a bilateral disagreement over fees, but a reflection of deeper shifts in how power, trade, and infrastructure intersect. As this story continues to evolve, the choices made by policymakers, businesses, and investors will help determine whether the global trade system adapts in ways that preserve stability, or whether it fragments under the weight of strategic rivalry, reshaping the flow of goods and the balance of economic power for years to come. As this chapter in the U.S.-China port fee dispute draws toward a temporary close, it leaves behind a powerful reminder that the global trade system is entering a period of profound transformation, one where economic decisions can no longer be separated from political strategy or national security considerations. What began as a dispute over fees imposed on ships has evolved into a revealing case study of how deeply interconnected and vulnerable the modern global economy has become. The one-year suspension of reciprocal port charges may ease immediate pressures on shipping companies and supply chains, but it does not erase the underlying forces driving this confrontation. Instead, it exposes the delicate balancing act both nations are attempting to maintain, where cooperation and competition coexist uneasily, and where every policy decision carries consequences that extend far beyond national borders. For governments, this episode reinforces the reality that trade policy is no longer confined to tariffs and quotas. Control over ports, shipping access, and logistical infrastructure has emerged as a potent form of leverage, capable of influencing markets and behavior without the dramatic escalation of traditional trade wars. This shift reflects a broader evolution in economic statecraft, where subtle regulatory tools can achieve strategic objectives while preserving plausible deniability and flexibility. For the United States, the dispute underscores concerns about long-term competitiveness, industrial capacity, and dependence on foreign-controlled logistics networks. For China, it highlights confidence in its ability to respond decisively while protecting its role at the center of global trade flows. Neither side can afford to push the conflict too far without risking self-inflicted damage, which explains the willingness to pause and negotiate even amid sharp rhetoric. For businesses operating within this environment, the lesson is clear and unavoidable. Predictability, once taken for granted, can no longer be assumed. Shipping routes, port access, and regulatory frameworks may shift rapidly in response to political developments, forcing companies to remain agile and forward-looking. This means building redundancy into supply chains, diversifying logistics partners, and preparing contingency plans for scenarios that were once considered unlikely. While such measures may increase costs in the short term, they are increasingly viewed as necessary investments in resilience. Firms that fail to adapt risk being caught off guard by sudden policy changes that disrupt operations and erode profitability. Investors, too, are recalibrating their expectations. The shipping and logistics sector is now widely recognized as being closely tied to geopolitical risk, and valuations increasingly reflect not just operational performance, but exposure to political tensions and regulatory uncertainty. This has implications for capital allocation, as projects perceived as vulnerable to policy shifts may struggle to attract funding, while those emphasizing flexibility and strategic positioning may gain favor. Over time, this could reshape investment patterns across the global trade ecosystem, influencing where and how infrastructure is built and modernized. At the international level, the dispute raises difficult questions about the future of cooperation in a world marked by strategic rivalry. Institutions and agreements designed to facilitate open trade face growing strain as nations prioritize control and leverage over integration. Smaller economies, heavily dependent on stable shipping networks, may find themselves navigating an increasingly complex landscape where access to ports and routes is influenced by political alignment as much as commercial logic. This could deepen divisions within the global economy, challenging the assumption that globalization naturally leads to shared prosperity and stability. Yet even amid these challenges, the temporary truce offers a cautious note of optimism. It demonstrates that dialogue and compromise remain possible, even when tensions run high and strategic interests collide. The willingness of both sides to pause and negotiate reflects an understanding that the costs of unchecked escalation would be felt not only domestically, but across the entire global system. This recognition may serve as a foundation for more structured discussions about the rules governing maritime trade and the use of infrastructure as economic leverage, though such conversations are likely to be complex and contentious. Ultimately, the significance of this episode lies not in the specific fees imposed or suspended, but in what it reveals about the evolving nature of global trade. Shipping is no longer merely a technical function that operates quietly in the background of the world economy. It has become a visible arena where power, strategy, and economic interests intersect. Every vessel crossing the ocean now carries not just cargo, but the weight of geopolitical calculations that can shape markets and livelihoods worldwide. As nations continue to explore new ways to assert influence and protect their interests, the maritime domain will remain a critical front in this broader contest. Understanding these dynamics is essential for anyone seeking to make sense of today's economic headlines and tomorrow's global trends. The story of port fees and maritime leverage is, at its core, a story about how power is exercised in an interconnected world, and how the choices made by a few can ripple across continents, shaping the future of trade, industry, and economic stability for years to come.